Everyone, and welcome to The Explainer. Today, we're going to pull back the curtain on something called trade finance. It's basically the financial engine that keeps global commerce chugging along. So let's start with a simple question. Picture this: you've got a cozy coffee shop in, say, Ohio, and you need to buy your next batch of amazing coffee beans from a farmer way down in Colombia. Now, here's the problem: the farmer, understandably, wants to get paid before they ship the beans, but the shop owner, they want to pay after the beans arrive safely. See that gap? It's a huge gap of time, distance, and, well, trust. So, how on earth do you solve that? Well, that's exactly where trade finance comes into the picture. It's the system designed to bridge those financial gaps and manage all that risk. It gives both the farmer in Colombia and the shop owner in Ohio the confidence they need to actually go through with the deal. So here's our game plan for this explainer. We're going to break down the 6 core features that make trade finance work, and we'll look at them in 3 pairs. First, we'll talk about that global finance gap. Then we'll get into the features themselves. And finally, we'll see how it all clicks together. Ready? All right, let's kick things off with Section 1, the global finance gap. We need to understand why trade finance is so incredibly essential in the first place. Okay, now that we get the why, let's move on to the how. Section 2 introduces our first pair of core features: the fact that these financial tools are both short-term and relatively small scale. So, what does short-term mean here? Well, think of it like this. This isn't a 30-year mortgage. Trade finance is designed to follow the physical journey of the goods. We're talking a timeline that typically lasts anywhere from 60 days to maybe a year. It's tied directly to the trade cycle, the time it takes for goods to get from point A to point B and then get sold. Here's a perfect example. An electronics importer might get a 90-day facility. Why 90 days? Well, maybe it takes 45 days for the electronics to ship across the ocean, and they figure they need about 30 days to sell them once they're in the store. The financing timeline is built to perfectly match that specific business cycle. And the second feature here is that these facilities are small. But small is a relative term. What we mean is that the financing is laser focused on just one part of the supply chain. The bank isn't handing over a giant check to fund the entire company's operations. Nope, they're financing one specific transaction. So you can see here, a big company might have a total credit line of, say, $50 million for everything they do. But the trade finance facility for one single shipment, that might only be $5 million. It's like using a scalpel, not a sledgehammer. It's a very precise tool for a very specific job. Okay, moving on to our next pair of features. And this is where things get really clever. We're going to look at how these transactions are designed to basically pay for themselves. This is all about being self-liquidating and specific. Now, this right here is probably the most important concept to grasp: self-liquidating. It's a fancy term, but it means something really simple and powerful. The transaction itself generates the money to pay back the loan. The repayment doesn't come from the company's general bank account. It comes directly from the revenue generated by selling the very goods that were financed. It's a beautiful, self-contained financial loop. Let's go back to our coffee shop. Here's how it works. Step 1. The bank provides the money for the importer to buy the coffee beans from Colombia. Step 2. The importer gets the beans, roasts them, and sells them to local shops. And step 3, the money from those sales is then used to pay back the bank. See, it's a closed loop. The deal funds itself. And that brings us to specific. These facilities are not a one-size-fits-all kind of deal at all. Each one is meticulously crafted for an individual transaction. And this means it's all about the paperwork. The bank needs proof, like actual shipping documents, before they'll release a single dollar. Just imagine you're importing some highly specialized machinery. The bank isn't just going to take your word for it. They're going to demand very specific documents, maybe even engineering certificates or a super detailed shipping manifest to prove that the exact right machine is on its way. This isn't just bureaucracy. It's a critical way the bank manages its risk. All right, we're on to our final pair of features, which are all about how banks protect themselves. Let's talk about how they manage their risk by being both selective and secured. It probably won't surprise you to hear that banks are, well, extremely selective about these deals. They're not just handing out money to anyone. They look at everything: the borrower's history, the type of goods being traded, even the political situation in the countries involved. They're doing their homework. So let's look at a quick comparison. On one hand, you have a reputable client who's been in business for years, importing something common like textiles from a stable, low-risk country. That's probably going to get a green light. On the other hand, What if a brand new client wants to import rare minerals from a country with a lot of political instability? Yeah, that's much more likely to be declined. It's all about weighing the risk. And this leads to the ultimate safety net for the bank. The facility has to be secured. This just means the borrower has to put up some form of collateral. Think of collateral as a guarantee. If the whole deal goes south and the loan can't be paid back from the sales revenue, the bank has a backup plan. They can claim that collateral to recoup their money. And this collateral can be a lot of different things. It could be straight up cash, a pledge on the goods themselves, or even the money that other people owe the company. That's called accounts receivable. It could also be legal documents like warehouse receipts that give the bank a claim on the goods sitting in a warehouse. The bottom line is the loan is always backed by something of value. Okay, so we've looked at all 6 features in their pairs. Now let's zoom out and put it all together. Let's see how these 6 pillars really work in action to support global trade. So let's do a quick recap. The 6 core features we've talked about are it's short term, it's small, it's self-liquidating, specific, selective, and finally, secured. These are the building blocks. And here's the most important takeaway. None of these features work in a vacuum. They all interlock to create this incredibly structured, robust system. It's this very structure that lowers the risk enough for banks to provide the liquidity needed to keep goods moving all around the globe. It's what makes the whole system possible. And that brings us to a really interesting question to chew on for the future. As our world keeps changing, with new technologies like blockchain and AI and a constantly shifting economic landscape, how are these fundamental features going to adapt? Will they become faster, more transparent? Could technology change their very nature? It's definitely something to think about. And that's a wrap. I really hope this explainer helped demystify what trade finance is all about. If you found this helpful, it would be awesome if you could hit that like button and subscribe for more. And I'm curious, what questions do you still have? Drop them in the comments section below. Thanks so much for watching.